You hear the mantra all the time, don't fight the Fed. It comes from the same people who quote Warren Buffett, except when he's saying it's not a good time to buy stocks. This is from the same people who have never looked into the books of a company and simply buy into companies they use regularly, thinking that is a sound investment strategy. Well, you came here for the truth, so let me unveil that for you. Today, I want to look at something different. This is going to be different than what I normally do. I want to take you down the pages of history to show you what has happened last time around. During the financial crisis, most people that are in the investment world today and the retail investors who are putting money in, whether that's through their 401k, that's through their Robinhood account, or the different online brokerages, many people didn't really understand what 2008 taught us. I'm going to show you exactly what you need to know. Let's begin. Out of CNBC, don't fight the Fed, join them. And I want to stop there for a second because we see this mantra all the time of don't fight the Fed, but it is quite painful to hear these words of join them. And you do not want to have any part in what the Federal Reserve is doing because, of course, this isn't helping you. This is siege. This is a takeover. They are buying up the assets without your permission. They did not even go through Congress. They did everything behind the scenes. And unlike what happened during 2008, which I'll show you in just a second, documented here, there was no opposition this time around. In fact, they were cheering for it to happen. Things have really changed. Essentially, the article that I'm showing here is telling you that you should buy the ETFs that the Federal Reserve will likely buy. You can get in front of them, they buy it up, and they are there supporting it in case we have a problem and it starts to fall. You don't need to worry because your masters will be there to save you. But let's take a trip down memory lane. Bear Stearns collapses, sold to JP Morgan Chase. On March 16, 2008, Bear Stearns, the 85-year-old investment bank, narrowly avoids bankruptcy by its sale to JP Morgan at the shockingly low price of $2 per share. They got into the mortgage-backed securities, and of course, that didn't exactly end up well because of all those derivatives and how they work. If you haven't read into it, you might have seen the different movies that were made about it. Regardless, big risks were taken and the fraud underneath was exposed. So that is March 16th, 2008. I want to take you through the timeline here and show you this as I reference back and forth with these different articles and statements. We're looking at the S&P 500 right at the beginning of the chart. It's around 2007 at this point, and then this goes to 2010, just to give you an idea. 2007 was a turbulent time. We saw real estate, but don't worry, everything's going to be okay. It's just subprime, nothing else to worry about here. We all know how that ended. Market starts to come down as we move into March of 2008. So March 2008, we really hit a low point, and this is where it starts to get critical. So let me show you something. There's a lot in here, and I definitely recommend reading it for yourself, but I just want to show you a couple points. In March 2008, in response to liquidity pressures faced by primary dealers, the Federal Reserve established the Term Securities Lending Facility, TSLF, as a means of addressing the funding pressures faced by primary dealers. This is a lot like what we're seeing today back last year, where things started to go haywire with the repo operations. That brought us into 2020 and everything we started to see. In the bottom paragraph, in March 2008, the Fed also established the Primary Dealer Credit Facility, PDCF. Primary dealers are broker-dealers that serve as the trading counterparties for the Fed's open market operations, and they play a key role in providing liquidity in the market for U.S. Treasury securities. You can go on, read the whole thing for yourself. Essentially, I wanted to show you that as of this point, March 2008, the Federal Reserve comes in. They're reacting to everything that's been happening. They're creating these new facilities. They're doing things they've never done before. All the while, interest rates are continuing to decline. They've never been this low at this point, and they're signaling that they're going to take it further. So at this point here, the market starts to come up. And we can see from March all the way into May, the market is rising. Well, of course, the Federal Reserve is doing all of this. We're seeing the activity out there, making things happen. They're fixing the problem. But it didn't really last that long. The market continues to fall over the next few months. During this period of time, we're finding out about the derivatives, all the scandals are unfolding, failures are popping up everywhere, and then there's more reaction. October 3rd, 2008, Congress approved $700 billion Wall Street bailouts. That's right, they went in and did something they have never done before. An unprecedented level bailout come in for Wall Street. Something I thought that was interesting, you can see the vote here, 263 to 171. Today, however, something like this would be unanimous practically. There is no problem getting any of this through today. All you need is a few people there, not even an entire Senate. They'll just pass it through, no problem. In general, the market likes it, but as they mentioned in the bottom paragraph, they want to see more from the Fed. They want to see them acting, reducing interest rates. At this point here, QE is pretty foreign to the markets. They weren't expecting it necessarily, but let me show you something. Just to note really quickly on the chart, you can see that the market continues to fall from this period of time all the way through. But this is really the key. Let me show you. November 25th, 2008, directly from the Federal Reserve's website. Federal Reserve announces it will initiate a program to purchase the direct obligations of housing-related government-sponsored enterprises and mortgage-backed securities backed by Fannie, Freddie, and so on. When you look at this, it happens to be something that is really a distant memory, but you can see the numbers on here. You can see the way that they acted. That was November of 2008, and what happened afterwards? Despite the beginning of what is QE1, it didn't help the markets. You can see that it continued to fall throughout this period, bottoming out in March of 2009. Then on March 18th, 2009, the FOMC released this statement saying that they would expand QE1. Right here, they will increase the size of the Fed's balance sheet further by purchasing up to an additional $750 billion of agency mortgage-backed securities, bringing the total purchases of these securities up to $1.25 trillion this year. Now, at that time, we're talking March of 2009, this is huge. This is monstrous. And yet, in this case here, 2020, they printed $2 trillion in a matter of just over 4 weeks. Just look at the magnitude at which they are responding to the current crisis. It makes QE1 look like nonsense in comparison. And after they decide to bring in the quantitative easing, the markets, of course, reacted positively. In addition to that, they actually brought the interest rates into the range of 0 to 0.25%. They, of course, expanded the QE1 policy. This helped the market come up tremendously, but it wasn't upon that initial mention of it, the initial creation of everything they had done, because we have seen the previous policies, what they tried to do, what the government tried to do as well with the TARP bailouts, with all the different programs. This did not help the situation. In the end, the market came down further. It might have reacted positively for a short period of time, but those turned out to be a dead cat bounce. And then the market came up after, when it was relatively close to fair value. The S&P 500 came down to a level of 666. Of course, no coincidence there. As you can see today, it heads ever closer to 3,000, shaking off and shrugging off all bad news. This is just a following statement in 2010, how they were going to close up their QE1. Of course, it didn't take long for QE2 to come through, and then QE3 following after that. The point I'm trying to make here is that people say don't fight the Fed, but if you would have taken that advice last time around, you would have got burned. There's so much more to it than that, and that's the entire point of this channel. It's to look at the failures of all of their policies and see how many people get burned. It never works out well for the average person. They think they can actually outsmart all of the fund managers that have literally teams of people that are researching and studying this on a daily basis. They think they outsmart them in the way that they invest because they've seen it come up to a point. There have been so many strong companies that have really taken a beating in their stocks because people don't know how to handle it. You must understand that the game is rigged, and it's rigged against you. The house always wins. That's all for this video. If you found it informative, hit that thumbs up button. If you hate me, hit the thumbs down button. Make your voice heard. If you own 7 shares of Amazon and were triggered by this video, you can also give me a thumbs down. If you want to find me on Instagram and on Twitter, I do content every single day. Don't forget to check me out at The Money GPS. If you want to learn how to sell online, I've got the best place to check out. It's a free e-course that I've created to help you get your situation in order to bring in some income. To learn about it for free, check out theamazongps.com. My 2 books will help you understand what has happened in history, bring it up to the present. You're going to learn all of the details. Check them out at the link in the description if you want the audiobook, themoneygps.com. Have you seen this video? It's so important to check out. I really hope that you'll spend a minute. Watch it at 2x if you have to. Click on it. I'll see you there.